Financial markets reward knowledge but punish uncontrolled risk. In this module, you will learn how financial literacy affects trading behavior and trading outcomes, why behavioral finance biases such as overconfidence, FOMO, herding, and loss aversion can lead to costly decisions, and how artificial intelligence, quantitative finance, and regulation can support more disciplined, less risky trading behavior. Join experienced trading, financial services, and regulatory experts, including Professors Patrick Groom, Marcel Lotcher, Wolfgang Rams, and many more. Book your place in the award in financial service management. Join the experts and become one yourself. Please visit our website or contact admissions at admission@eim.education for further information. Every trader knows this moment. A price moves. A headline appears. Your screen turns green or red. And suddenly, the question comes faster than the analysis. Should I buy? Should I sell? Should I wait? Or am I already too late? In financial markets, the difference between a decision and a reaction can be expensive. Financial literacy is not just about knowing financial terms. It is about understanding risk, return, cost, leverage, probability, behavior, and uncertainty. It is also about understanding yourself. Because in trading, your biggest risk is not always the market. Sometimes it is your own confidence, fear, impatience, or need to follow the crowd. That is why the award in financial service management, a government accredited higher education program, introduces you to the knowledge, tools, and decision frameworks needed for more disciplined, less risky trading behavior. Many people enter financial markets believing that success depends mainly on finding the next winning trade. But trading outcomes are shaped by much more than prediction. They are shaped by transaction cost, bid-ask spreads, leverage, timing errors, taxes, volatility, liquidity, and emotional decision-making. A trade can be directionally correct and still produce a poor outcome if it is oversized, poorly timed, over-leveraged, or repeated too often. Research on individual investors has shown that very active trading can damage performance. The issue is not that traders lack intelligence. The issue is that action feels productive, even when it is costly. This is one of the first lessons of financial literacy. More trading does not automatically mean better trading. In the award in financial service management, you learn to distinguish between a trading idea and a trading decision. A trading idea is a possibility. A trading decision requires evidence, risk limits, execution planning, and discipline. Financial literacy gives you the ability to ask better questions before money is at risk. What product am I trading? What is the source of return? What is the downside? What could go wrong? How much can I lose? What costs are hidden? What assumptions am I making? Am I investing, trading, speculating, hedging, or gambling? In this module, financial literacy is treated as practical decision competence. You will explore core concepts such as risk and return, diversification, market efficiency, portfolio construction, leverage, margin, liquidity, volatility, trading costs, financial products, client suitability, and the role of regulation. You will also learn why financial literacy is not only technical, it is behavioral. Knowing what risk means is one thing. Acting correctly under pressure is another. That is why this award connects financial literacy with behavioral finance, quantitative finance, and artificial intelligence. The aim is not to remove risk. No serious financial education can promise that. The aim is to understand risk, measure risk, communicate risk, and manage risk more intelligently. Even financially literate people can make poor trading decisions. Why? Because financial markets create emotional overconfidence tells us, I understand this better than others. Confirmation bias tells us, the evidence supporting my view is more important than the evidence against it. Loss aversion tells us, do not realize the loss. Wait until it comes back. The disposition effect pushes investors to sell winners too early and hold losers too long. Herding says, everyone else is doing it, so it must be right. FOMO says, if I do not enter now, I will miss my chance. These biases do not make people irrational all the time. but they can become dangerous when combined with leverage, volatility, social media, and fast execution platforms. In the award in financial service management, you learn to identify these biases before they become trading mistakes. You learn to pause, diagnose, and ask, am I making a financial decision or am I reacting emotionally? Modern trading environments make financial literacy more important than ever. Markets are faster, more accessible, and more complex. Retail traders can access products that once required professional infrastructure. Derivatives, leveraged instruments, crypto assets, contracts for difference, algorithmic tools, and high frequency market data. Cryptocurrency markets are a useful example. They operate continuously. They are volatile. They are strongly influenced by sentiment, narratives, social media, and crowd behavior. Crypto derivatives, including perpetual futures and perpetual swaps, introduce additional complexity. These contracts have no fixed expiry date. They use funding payments to keep the contract price close to the underlying asset. They require margin, allow leverage, and can trigger forced liquidation when collateral is insufficient. For an uninformed trader, these features may look like an opportunity. For a financially literate trader, they are also sources of risk. This module does not teach students to chase hype. It teaches students to understand product mechanics, market structure, risk exposure, and behavioral vulnerability. In financial services, that distinction matters. Quantitative finance helps turn uncertainty into measurable information. It does not predict the future with certainty. It gives you tools to test assumptions, estimate risk, and compare decisions. In this award, you are introduced to the logic of quantitative thinking. You learn how traders and financial service professionals use data to examine volatility, drawdowns, position sizing, expected return, risk adjusted performance, diversification, correlation, and scenario analysis. You learn why a strategy should be tested before it is trusted. You learn why a high return is not meaningful unless you understand the risk taken to achieve it. You also learn the importance of backtesting, stress testing, and model limitations. A trading rule may look attractive in calm markets but fail during volatility. A portfolio may look diversified until all assets fall together. A risk metric may look precise while still being based on fragile assumptions. Quantitative finance does not eliminate judgment. It improves judgment by making risk visible. Artificial intelligence is changing financial services. AI can help analyze data, summarize information, detect patterns, classify news, support forecasting, build dashboards, automate research, and test trading hypotheses. But AI is not a magic signal. A model can be wrong. A dataset can be biased. A backtest can be overfitted. A forecast can fail when market conditions change. That is why AI must be used with financial literacy and quantitative discipline. In the award in financial service management, you explore how AI can support decision making without replacing responsibility. You learn how to ask better prompts, evaluate model outputs, check assumptions, compare scenarios, and understand the difference between correlation and causation. You also consider the ethical and professional responsibilities of using AI in financial services. The professional question is not, can AI give me a trade? The better question is, can AI help me understand the risk, evidence, uncertainty, and limitations behind a decision? The award in financial service management is designed to connect academic insight, market practice, regulation, and professional judgment. You will not only learn from textbooks, you will learn from experienced specialists who understand how financial markets work in practice. The module brings together respected academics, successful practitioners, trading specialists, quantitative finance experts, and regulatory professionals, including Professors Patrick Gruen, Marcel Lotscher, Wolfgang Rams, and many others. These are experts who bring real experience into the learning environment. From financial services management and market regulation to trading behavior, risk management, cryptocurrency derivatives, artificial intelligence, and quantitative finance. The learning journey combines five elements. First, you build financial literacy, the language of products, markets, clients, risk, and regulation. Second, you study behavioral finance, the biases that influence investor and trader decisions. Third, you apply quantitative finance, using data, models, and structured analysis to understand risk and performance. Fourth, you explore artificial intelligence, using digital tools to support research, analysis, modeling, and decision review. Fifth, you reflect on professional responsibility, suitability, transparency, ethics, governance, regulation, and client protection. Through mini cases, trading examples, risk scenarios, behavioral diagnostics, AI supported research tasks, and expert led discussions, you learn how financial decisions are made, challenged, and improved. The goal is to help you move from instinctive reactions to structured financial judgment. Join the experts, learn from their experience, and develop the knowledge, discipline, and confidence to become an expert in your own right. Financial markets will always involve uncertainty. No course can remove that. But education can change how you respond to uncertainty. Financial literacy helps you understand the products you trade. Behavioral finance helps you understand the mistakes you're most likely to make. Quantitative finance helps you measure risk rather than guess it. Artificial intelligence helps you analyze more information faster, but only when used critically. Together, these tools can support less risky, more disciplined trading behavior. The award in financial service management is for students who want to move beyond casual market watching and develop a more professional approach to financial decision making. If you want to understand markets, manage behavioral biases, use AI responsibly, and think quantitatively about risk and return, this module is designed for you. Book your place in the award in financial service management. Learn before you trade. Think before you act. Manage risk before risk manages you.